Hello and welcome back to the channel. Today we're talking about one of the greatest wealth-building stories of all time. How Warren Buffett turned a modest investment into a fortune of over $150 billion using one simple investing formula. This isn't about luck. It's not about high-frequency trading or betting on risky stocks. It's about patience, discipline, and a strategy that anyone can use. The secret? Compounding and value investing. The two core principles that transformed Buffett from a young investor in Omaha into one of the richest and most respected financial minds in history. Buffett himself has called compounding the eighth wonder of the world. But what makes compounding so powerful? It's the idea that money grows exponentially over time when reinvested properly. The best way to understand it is to compare simple interest and compound interest. Let's say you invest $10,000 with a 10% annual return. With simple interest, after 10 years, you would have $20,000. Your original investment plus $1,000 per year in gains. But with compounding, your returns generate their own returns. That same 10% reinvested yearly would grow your investment to over $25,900 in 10 years, $67,000 in 20 years, and over $174,000 in 30 years, without adding a single extra dollar. Now, imagine that process continuing for 50, 60, or even 70 years, which is exactly what Buffett has done. His fortune isn't just the result of smart stock picking. It's because he started investing early and never stopped. Buffett began his investing journey at just 11 years old, buying shares of Citi's service for $38 per share. He later sold them for a small profit. But if he had held them for decades, the power of compounding would have turned that small sum into millions. As he grew older, he studied Benjamin Graham, the father of value investing, and realized that instead of jumping in and out of stocks, the best way to build wealth was to buy great businesses and hold them for the long term. A perfect example is CocaCola, one of Buffett's most famous investments. In the late 1980s, the stock market had crashed, and Coca-Cola was trading at a discount. But Buffett looked deeper. He didn't just see a soft drink company, he saw a globally recognized brand, strong cash flows, and a product with an enduring competitive advantage. So instead of panicking like most investors, he bought over $1 billion worth of Coca-Cola stock. That one decision has earned him over $25 billion in returns, purely through compounding. The dividends he receives from Coca-Cola today alone are worth more than his original investment. This is the power of compounding at work, owning high-quality companies and letting time do the heavy lifting. But Buffett didn't stop at Coca-Cola. Another textbook example of his patience and value investing is American Express. In the 1960s, the company faced a massive scandal, the Salad Oil Scandal, where fraudulent inventory claims caused a financial disaster. The stock plummeted, and investors abandoned it. Buffett, however, saw the bigger picture. He realized that American Express had a strong brand and a loyal customer base. He understood that trust in financial institutions doesn't disappear overnight, so he invested heavily. That investment has since generated billions of dollars in returns. This brings us to another key part of Buffett's formula: buying when others are fearful. One of his most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." During market crashes, most investors panic and sell, but Buffett does the opposite. A great example is his investment in Bank of America. After the 2008 financial crisis, Bank of America was in trouble. Most people saw risk. Buffett saw opportunity. He struck a deal to buy preferred shares with a 6% dividend yield and the option to convert them into common stock later. When the bank recovered, those shares soared in value, earning him tens of billions of dollars. Buffett isn't interested in quick gains. He knows that great businesses become even greater over time. And if you hold on to them, the compounding effect will turn a modest investment into a fortune. One of the most overlooked aspects of Buffett's strategy is avoiding bad investments. Most investors get caught up in hype, chasing the latest trends, buying into speculative bubbles, or trying to time the market. But Buffett's approach is simple. If he doesn't understand a business, he doesn't invest in it. This is why he avoided tech stocks for decades. During the early 2000s, as everyone poured money into internet companies, Buffett stayed away. He believed that most tech companies were overpriced and had uncertain long-term prospects. And he was right. The dot-com bubble burst, wiping out billions in investor wealth. But when Apple came along, he saw something different. Apple wasn't just a tech company, it was a brand. Buffett recognized its consumer loyalty, strong cash flow, and ability to generate steady profits. So, in 2016, he made one of his biggest bets, buying billions of dollars worth of Apple stock. That investment has since earned Berkshire Hathaway over $100 billion in profit. The essence of Buffett's investing formula is this: buy great businesses at the right price. Let compounding work for decades. Ignore short-term noise and focus on long-term value. Another major takeaway is Buffett's discipline. Most investors feel the need to constantly trade, check stock prices daily, or react to market news. Buffett does none of that. He has often said, the stock market is designed to transfer money from the active to the inactive. One of the best examples of his patience is his investment in Geico. Buffett first bought shares of Geico in the 1950s because he recognized the company's direct-to-consumer model was disrupting the insurance industry. Decades later, after watching the company grow, he bought the entire company outright. Today, Geico is one of Berkshire Hathaway's most valuable assets. Buffett's long-term approach is why he has outperformed almost every investor in history. But here's the most important part. You don't have to be a billionaire to apply these principles. Buffett himself has said that most people would do best by simply investing in an S&P 500 index fund, because over time, the market as a whole goes up, and compounding will work in your favor. If Buffett had done nothing but invest in the S&P 500 throughout his life, he still would have become a billionaire. That's how powerful long-term investing is. But most people never allow compounding to work for them because they're impatient. They jump in and out of stocks, chase trends, panic during downturns, and try to time the market. Buffett does the opposite. He buys when others are fearful, he holds when others are impatient, and he lets time do the heavy lifting. So if there's one lesson to take away from Buffett's journey to $150+ billion, it's this: find great businesses. Buy them when they're undervalued. Hold them for decades. Let compounding do its magic. It may not be exciting. It may not make you rich overnight, but it works. And it's the exact formula that made Warren Buffett one of the wealthiest people in history. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell for more investing wisdom from Warren Buffett, Charlie Munger, and other great minds. Thanks for watching, and remember, investing isn't about gambling. It's about making smart, patient, and calculated decisions.